Okay, so good morning, everyone. This is the macro snapshot, Friday, January the 17th, 2025. Fairly quiet day today, not a huge amount of data. Everyone more or less in wait and see mode, I would say, although we do have option expiries in wait and see mode until Monday, when we get, of course, the inauguration of President Trump, who may or may not unleash volatility in terms of policy announcements on immigration and tariffs and whatnot. We shall see. Okay, but just want to do a quick review of what happened yesterday. Kind of interesting, just the data. The data in the US in terms of the economy continues to remain quite strong, although there was a couple of mixed signals yesterday. So if you look, for example, at the Philly Fed business outlook, that came in, the expectations consensus was -5, came in at 44. Very, very strong, very, very strong new orders components. Employment component was very, very strong. So you have to say that small business sentiment and business sentiment is strong in the US. So that was very strong. Then we look at the retail sales. It looked on first opinion, on first view, to be a little soft. So you see here the headline number, consensus 0.6 came in at 0.4, and you can see some of the core numbers, ex autos, a little softer. But having said that, the core number was revised upwards, and the control group, which takes out the volatile food, was to take out automobiles, gas, sort of home building, and a couple of other more volatile sectors. That was actually up 0.7, so pretty strong. So you could look at retail sales and say, oh, slightly soft, but there were some strong elements and certainly nothing weak or negative. So fairly strong. And then from a prices perspective, you had the import price index, actually, which was up. That was expected to come in at 0.1, previous 0 up to 0.3. So there could be some slight sort of inflationary inputs there. I was reading some stuff just now. The people who crunch these numbers saying that import price index, the fact that that went up a little bit, that could add an extra tenth or so to the PCE which we're getting. So that's still what it's indicating is that inflation is not really softening in a major way at this point. It's sticky, certainly not going down. And then, of course, the initial jobless claims, as always, very, very strong. I mean, 217,000. You could argue that's a little more than expected, and the revisions are up a couple of thousand. But as I say, from experience, anything to get near recessionary numbers, you're talking, you need, 300,000, 350,000, 400,000. We are very, very far away from a weak job number. So my takeaway for that data yesterday was, quite solid. Things going along quite strongly, and certainly nothing to indicate a very weakening, an economy which is very much weakening, or perhaps even booming. This is just a sort of robust economy. But what's interesting, if we look at a couple of charts, and I was just looking now, for example, at the 2-year yield, which I'll bring up here. It's essentially back. If you remember, we had the pretty strong non-farm payroll. So this is the yield on the 2-year government bond. And as you can see last Friday, which is essentially a week, literally a week from ago from now, as I'm recording this in the morning, basically that had gone up to about 4.42%, and we're actually below that. And if you look at something like the 10-year, you can see that we're a lot below where we were last Friday. And on the 30-year, we're below it. So it's interesting that the market, what is it trying to tell us? We could first of all see that, just looking from the yield perspective, the bond perspective here, that on the 30-year, the 5% seems to be an area which, I'm not going to say it's a cap, but it does definitely seem to be an area where real buyers and real support will come in, and there'll be some interest at locking in long-term yields by real asset allocators at 5%. So, there's been a lot of doom and gloom saying that the long end is going to sort of rip, higher and steepen forever. And it's possible, but I think just at the market, and probably definitely until Monday, and any more clarity from on Trump's policy, I think we're going to be in a sort of a pretty technical market and just range trading, and that the 5% is going to be is going to be pretty much like sort of a level. Also on the 2, I mean, what that's telling me here is that even with the sort of the strong data, the 2-year yield did go up, but as we see, it's sort of trading in a box here. We can see that this level here at about 4.42, which is just a little bit above the effective Fed funds rate. So the effective Fed funds rate, 4.33. So just about 10 basis points above that. And the market seems comfortable with that. And the market seems to be saying that I would say two things. Number one is that I don't think the market really believes that even if we have very strong data, that the Fed is in any mood to hike in 2025. That would really be kind of embarrassing, to be absolutely honest, for the Fed. They did the 50 basis point cut back in September, which some people are already calling a policy error. And I don't think Powell is any mood to sort of, especially with the new administration of Trump, and we know the problems they've had in the past. I don't think Powell's in any mood to, overtly admit an error. I think if the data remains strong and inflation remains sticky, and both of those are, quite probable situations, I think Powell's preferred course of action would be just simply to do nothing and just not to cut rates rather than hiking rates. So all that to say that I think the 2 year and the very front of the curve, I mean, it could go up maybe a little bit more, maybe another 5 or 10 basis points up to about 4.55, something like that. But I think pretty much we're getting to a level now of stability. And those of you who, interested in, I think basically that's a fairly interesting buying opportunity if you get anything around those levels, and also in the SOFR curve, which we can look at in a second. So I think that's what it's saying, and I think also it's saying that the the price action here is also saying that the market is pretty comfortable where it is on the short end here. Okay, so that's just what I wanted to look at. And then yesterday as well, we had Besant, which I actually listened to the confirmation hearings. My takeaway, first of all, on a psychological or personal level, was that I was a little surprised. He seemed quite nervous, quite hesitant, not really a very eloquent speaker, not particularly forceful. He didn't seem, in my humble opinion, to show a lot of political savvy. Some of the questions I think he could have answered in a more assertive way, but maybe that's his character. So it's just going to be interesting to me to see how he deals with Trump, to be absolutely honest. And just and if we look at some of his past public sort of statements, and one of them was from his hedge fund from a year ago, he's certainly not necessarily in the camp which believes that universal and high tariffs forever is a good thing. And that a very strong dollar is always a good thing. So it's going to be interesting to see how they mesh from a personality point of view, but also from a sort of substantive policy point of view. Having said that, yesterday he didn't upset anyone, and he seemed competent and calm, and that's probably a good thing if you consider some of the other nominees by the Trump administration. One thing he did say, which definitely got a market reaction for a little bit, was that he seemed to be firmly in favor of sanctioning Russian oil supplies even more aggressively. Now, again, I don't know if that's a lack of political experience that he sort of made those fairly robust comments, but definitely oil, the front month in oil got a sort of a 50, 60 cent sort of pump on that, a boost on that, but it sort of came down a little bit. But so that's interesting to see if the Trump administration, and certainly Scott Bessent, will not only keep the recent sanctions which Biden just put on, or secondly, maybe even will ramp up the sanctions. And who knows, maybe this is part of a negotiating tactic, by the Trump administration and Bessent to try and bring Putin to the negotiating table for Ukraine. Anyway, so I thought that was sort of, to be absolutely honest, an unnecessary comment and quite an assertive comment. So we'll see. We'll keep an eye on that. Overnight, the other thing which I just want to point out is some data from China, which actually was quite robust. Again, quite strong. I don't want to say, hey, China's recovering, but you have to say that, again, we always have to look at the Chinese data with a pinch of salt because we never quite know how accurate it is. But hey, that's what we're dealing with. And kind of interesting here, if you look at the data overnight, which, where is the data? We had GDP and a few things. Yeah, so if you look here at the GDP data, you can see year over year, 5.4%. So that's a big jump from last time and also over expected. We also see that a quarter on quarter, well, that wasn't so good there, seasonally adjusted, but basically the headline numbers pretty good. Industrial production was good. You can see retail sales was higher than expected. So the point is here, a little bit of good news out of China there. Interestingly enough, for me at least, there wasn't a big jump in the sort of risk assets. We see this morning the Aussie dollar down, New Zealand dollar down, Canadian dollar down, and Chinese stocks not particularly doing anything. So I guess the market maybe possibly is waiting for more data out of China, more consistent data. But the reality is as well that the market's probably just waiting for Trump because, if anything, rather than tariffs on Europe, Mexico, and Canada, which Trump has talked about, really what a lot of people are sort of expecting or perhaps even fearing is some pretty aggressive commentary or even policy action from Trump as early as next week, which of course is going to be very, very important for China. So interesting there. All right, so just while I've got the terminal up here, a couple of things I'm keeping my eye on here is just I've got the VIX curve here. So volatility down. And you can see here the front of the curve. So you see spot here trading in backwardation, which is its normal place, down at pretty reasonable levels here, just above 16. And you see here just comparing to what's gone on. This is from 1 day ago. So you see that the front end, the spot came down a little bit. If we go back a week, I believe you could see here that not only has the curve gone more into contango, which indicates less stress in the market, less need, less volatility, and less fear, so to speak, but you can see here that the actual price has gone down. So we see that the VIX levels have gone down, but also the curve has flattened substantially in the last week and gone into contango. So all things considered, for the volatility targeting funds, that should be a bit of a positive for stocks. I also think, in the absence of data today and, relatively robust retail sales, good employment report from the initial jobless claims, and nothing to, and of course the CPI was relatively, acceptable, I would say. I wouldn't say it's benign or good, but is acceptable. It could be that stocks have a little bit of a kick up today. So let's have a look at just where the stock market is. Just briefly, I'll just put it up here and of course the earnings have been, pretty robust so far, especially the financials. So if we just have a look here at the S&P, you can see up the futures up almost 0.5%. So looking pretty good here. As I say, sort of technically a bull flag, 100-day exponential moving average bounced off that. Bit of a downtrend resistance, had a bit of a pause yesterday. But honestly, I think again, we've got maybe a bit of volatility today because we have the monthly option expiries on the Friday, which is today. It wouldn't surprise me at all if equities get up to this level before Trump, maybe 6,045. That to me looks like a reasonable target. It's about 50, 70. Well, I guess I could measure it. There we go, about 65 basis points away. So that seems to be quite a reasonable target, maybe even a little bit higher. I mean, NASDAQ, similar thing, already up 65 basis points on the futures. I think that could, again, sort of a flagging formation potentially, that could head up a little bit higher. One thing which is interesting that, as I said, just looking at the Chinese data, even with that strong Chinese data overnight, you got the CSI 300. I mean, technically a tiny green candle here, but nothing really strong. The A50 not doing anything, and the stocks, which the Chinese mainland stocks, which trade in Hong Kong, I mean, not going down, but nothing massive. So interesting though, if we get on, let's say next week, how can I say, less aggressive rhetoric from China, on China from Trump, and we continue to get some signs of, relatively, small, some improvements in the China space. It could be the case that, the Chinese stocks could have a little bit of a breakout, and maybe something like FXI, which is the large cap ETF for China, that's been beaten down quite a lot, well below the fib level, retracement levels here, trading here, as you can see at the 200-day EMA. Well, actually just above it at the 100-day EMA here, but that could definitely be due a little bit of a bounce. If Trump sounds reasonable and is not super aggressive in the first day or two, combined with a better news out of China internally and domestically, and that could also lead to things like some of the Australian dollar, some of those risk assets maybe doing a little bit better. So just talking about the Aussie dollar, you see here still pretty much beaten down against the US dollar, which continues to be strong. I mean, if you look this morning, we can see the dollar index up 13 basis points, and if you look at the majors here, these are on the futures, but you can see they're all red. Anything from euro, well, euro pretty flat, but you see the higher risk currencies are down, anywhere between 20, 30, 40 basis points. Even CAD, for example, down, 25 basis points. Still trading in a range, but definitely weak, and probably, to be honest, like China, or waiting with interest, shall we say, the news about tariffs and whatnot. The other thing which I just want to quickly look at, guys, is oil. Again, as I said, Besant yesterday said there could be more sanctions or heavier sanctions sort of in the pipeline. But oil really here, this is on the CL1 contract. The new March contract is a little more clearly a triple top for here. But basically, oil sort of just taking a little bit of a pause, not really getting too much encouragement from the overnight news from China. But again, we all know that there is a surplus in the market and that OPEC is holding back. And I was just reading some research this morning that it seems the tanker companies, the insurers, the traders, the whole infrastructure of oil in India and China already they're starting to reroute to book other tankers to form new companies. So that disruption caused by the Biden administration's sanctions. I think, the oil market is extremely sort of nimble and extremely flexible. And I do believe that ultimately on the ground, physical shortages will probably not happen. That's the kind of information I'm reading. It's difficult to know exactly what's happening everywhere in the world, but at least from the research I'm reading, it seems that, the supply chains of oil are sort of, relatively quickly getting back into business. And we're just seeing that a little bit of softness here. Now, of course, this chart is still bullish. So, probably what we could see or might see, it's not yet a negative chart. So if we look at this short-term fib here, we're only just down to 38%. I mean, it's not really negative, I would say, until it gets below, let's say, 75.90 from this one. And even on the longer-term fib, if we just drag it down here, you can see that if we just look at this, the whole bull impulse going back to, let's say, mid-December, that oil essentially has done no technical damage, so still bullish. So let's not believe that oil is going to collapse here. It's simply taking a pause. And it's interesting. I always like to look at the time spreads in the curve, and if we actually look at the, I think I put it up here. If we look at the, let's see, here's the time spread. So you can, no, sorry, this is just the curve for oil for CL. For WTI, you can see it's still very much, it's still very steep, still very much in a backwardation kind of structure. I mean, you could say, is the front end here slightly starting to flatten? We'll have to look. I mean, if we go back a week, just as a comparison, you can see that actually compared to a week ago, which is the yellow line, it's still, I mean, you could argue here that it's flattening a little bit, but still the outright prices are higher. And if we go, sorry, let's have a look. I've got a lot of stuff up here. If we go, let's say to a spread, which I've been looking at, this is the front contract here, which is March 2025 out to June. So kind of like a 3-month spread, 5-minute chart. So definitely we had a bit of a spike up in the prices, and you can see that the spreads definitely blew out a little bit up to a high of 408 basically yesterday, and it's coming down and softening. So I do believe that's going to come in a little bit just as those supply pressures ease up, but not exactly collapsing. So just looking at the calendar spreads here and the shape of the curve itself, I think oil is pausing and consolidating rather than collapsing, because the reality is these sanctions are quite serious. And also the fact that Besant yesterday indicated that that was a sort of a good thing, essentially. I think maybe the oil market's a little bit nervous. And of course, with Trump coming in, there could be the potential for extra sanctions on Venezuela and Iran, both, obviously significant oil producers. So who knows, maybe we suddenly get, extra sanctions not only on Russia, but also on Iran and Venezuela. And that could, I think that's keeping the oil market a little bit sort of in balance there. Other thing I just want to look at here, guys, just why I've got it up here, just the SOFR curve for the short-term futures. I was just saying where that's gone. If we look, and it's just interesting again to look from a week ago, and you can see here, I mean, I'll just zoom in a little bit. You can see here where we're at now is the white line. And you can see that, as soon as you get out into, the second half of 2025, 2026, each dot represents a 3-month sort of contract on the SOFR. You can see that the yields have come down quite a lot. So it's just interesting that with that very strong non-farm payrolls, the market really seems to be in a mood to sort of almost to give the Fed the benefit of the doubt. But talking about the Fed, it's interesting because I think there's quite a lot of internal division. And yesterday we had a few speakers, and we had a fairly, I don't want to say extraordinary, but an extremely dovish interview given by who was it? Sorry, Waller at the Fed, who essentially said that multiple cuts were possible, maybe even as soon in 2025, maybe even as soon as March. Extremely dovish. He also said that his view was a little bit non-consensus. So I just wonder if he's trying to position himself politically to curry favor with Donald Trump, who we know likes low interest rates, because it was an extremely dovish take, basically saying that, inflation seemed to be going towards target. And if the data cooperated, multiple cuts in 2025 was still his base case. So that definitely helped the front end of the of the yield curve, the stir market, and also the 2 year. But on the other hand, we did have a couple of other speakers yesterday from the Fed who were a little bit more circumspect and just saying that inflation hadn't yet been defeated. So interesting how Powell's going to navigate that. It's quite a lot of internal division, but definitely, until and unless we get new data, it looks like just for the time being that the front end of the curve and yields in general are going to come down a little bit and stay maybe range bound. So, just from a trading perspective, in this technical market today, I mean, I don't know if it's a great trade, but, potentially sort of selling volatility, selling puts on the equities or maybe on the bonds, in theoretically is possibly an interesting idea. But of course, you have massive event risk. Next week with Trump's inauguration. So that's maybe not such a, that's a very short-term kind of idea. Okay, guys, I'll leave it there. Let me think. I think on Monday, the markets might be closing early. I'll have to check. I think it could be Martin Luther King Day. And of course, we have the inauguration, which is going to be necessary to keep an eye on what's going on there. Otherwise, have a great day and a great weekend. Thank you.